It's kind of really in the point where we should start to see things change and narratives change fast. That's what I'm really focused on. This next 2 months of economic data, if it's not a lot worse than expected, then every single, I produced in that GMI, you saw it's like 60 charts, all showing the same thing. I've never seen anything like this before. For them all to be wrong would be simply staggering. So we'll see. When you've got a managed economy, crisis rolls slowly. Don't forget, Japan's still unwinding its demographic bust and its bubble from 1990 because it's quite managed in how it does things. So the Chinese economy is an issue. You know, there's been excess leverage, excess capacity built at every level, and they're going to have to manage this. And what they want is a managed decline. They know it's a problem. Chinese economists, central bank, politicians are a very smart bunch. They understand their economy very well. They understand the issue that they've got. But at margin, firstly, it's going to create stimulus because they're going to have to stimulate. So that's going to be positive at the margin for risk assets. But also, it's going to keep the Chinese economy from not demanding as much stuff. You know, China's never going to go back and build the same amount of bridges and apartment buildings again unless it knocks them all down and starts again. Those days have gone. Yes, they're a big demand, but it's the rate of change that matters, and the Chinese rate of change of demand is not going to go up.
It's been a rough week for Bitcoin and Ethereum prices, and Federal Reserve Chairman Jerome Powell has a lot to do with it. Bitcoin and Ethereum both saw big drops, with Bitcoin falling below $20,000 and Ethereum dropping below $1,500 for the first time in over a month. The drops followed a speech by Federal Reserve Chairman Jerome Powell last week in which he poured cold water on hopes that the Fed might pull back on more rate increases this year as it continues its fight to slow inflation. Hello and welcome to Crypto Future Channel. In today's video, Real Vision CEO Raoul Pal addresses the most common concerns related to the global economy and tightening of the financial conditions in the past few days. Raoul explains the reasons behind peaking volatility and high inflation and the key strategies that we need to adopt to combat this situation, along with the climbing recession fears.
That is the single most powerful thing you can understand, is how much risk you're running. And what you tend to find is the closer your stop loss, the less risk you run unless you use leverage. So you can use leverage, but you have to run a tighter stop loss because leverage is increase the size of your position. You'll lose more of your original capital because leverage is the extra capital on top. So stop losses are different for different people. I'm not a big stop loss. I'm more of like, this trade is not working. I allow myself a lot of wiggle room because I'm longer term. Only when I'm really applying to a trade where I'm going all in, will I then start thinking about, okay, I need to be more careful here because I've got a lot of risk. And so therefore I'll think of stop losses for part of the position, all of the position, take profits, all of that kind of stuff. The hardest part is not stopping out of a trade, it's actually taking profits. It's bloody hard, particularly in long-term trades.
Bitcoin hodlers are asking questions after 10,000 Bitcoin dormant since 2013 suddenly left its wallet. On-chain data flagged on August 28 to 29 confirmed a large tranche of Bitcoin had become liquid again after nearly a decade. Analysts first began to notice curiously high transaction volumes this weekend as 5,000 Bitcoin was included in a block. Having stayed in the same wallet since 2013, the funds, the owner of which remains unknown, were soon joined by a near-identical 5,000 Bitcoin a day later. In total, 10,000 Bitcoin were moved for the first time since 2013, and Unchained sleuths are curious as to the motive of the whale in charge. Analysis of the destination wallets has concluded that the funds were not sent to an exchange for sale. Instead, they were split among a large number of new wallets.
People look back immediately and go, well, look what happened in 2008. Your 2008 was a very unique event. That was a massive credit event. 2000, well, the economy didn't go down a lot, but there was massive speculation in equities. We haven't seen the same. We've had excess liquidity, some excess speculation, but not of the scale of then. Most people who comment on that didn't live through it. I lived through it. I was running a hedge fund at the time. I was all over it. It's very, very, very different environment. We saw elements of it last year. At the very peak of the markets, we saw elements of that, but it's still extremely different.
Markets have been struggling since Federal Reserve Chairman Jerome Powell took center stage on Friday at the Fed's annual Jackson Hole Economic Symposium and essentially told the market that the Fed had more work to do to rein in high levels of inflation. Investors took the information to mean that the Fed would continue to raise interest rates until it saw further evidence that inflation was on the decline.
I know the Fed want to get to 4%, but my work suggests that the economic data will fall apart too fast for that to happen.
This is federal funds rate for people who aren't following this as close.
That's right. So that's the official interest rate from the Federal Reserve. I don't think they will potentially get there because the economic data will fall apart faster. So maybe they do a 50 basis points in September, and then they're kind of like, do we do 25? Do we just wait and watch the data? Because they've said they'll go data dependent. And if the data falls apart, 2 months is not a lot of time. So maybe they get 2 rate rises in, maybe they only get 1 in. I think it's going to be difficult if I'm right about the economic data this month. I think it's going to be really hard for them to do 75. I think they'll go 50. They've already said it's 50-50 anyway, whether they'll go 75 or 50. And then we should start to be getting to the grips of the massive slowdown in the economy that I foresee, and therefore they might not get to the 4%. But they will pause and wait. They're not going to cut immediately. That's not going to happen. But they're going to pause and wait. The Eurodollar market and Fed funds market says they start cutting next year, and it keeps moving around when they start that. But that's what they're thinking. The other big part of the equation is the dollar. The dollar is the key asset of all assets. It is 80% of all world's trade is priced in dollars. So if the dollar goes up or down, it matters. The dollar is driven by global liquidity as well. And there's massive dollar borrowings around the world.
The longer the Fed raises rates, the tougher it could be for growth stocks and other risk assets such as cryptocurrencies, because rising rates tend to make safer assets more appealing and bring down the valuations of growth and risk assets. Given that Bitcoin and the crypto market went on a huge run in 2021 and that they are pretty hard to truly value, high rates have crushed the crypto market and the price of Bitcoin is down more than 58% this year. The other issue crypto investors may want to consider is that the Fed will also ramp up quantitative tightening in September, in which the Fed allows its massive balance sheet to start winding down, which effectively pulls liquidity from the economy. This may reduce the amount of funds flowing into riskier assets like crypto.
At worst is when does it happen? At best is maybe it doesn't happen. So we all understand the risk, but it's geopolitics. We have no idea how this plays out. I understand that the Russian situation put it to the forefront of people's minds, and it's definitely a possibility. But I don't think China wants to cut itself off from the world, and I don't think the US wants to cut itself off from China yet. So I don't think it's in anybody's interest. It's kind of this stalemate situation where it kind of rises up. It's like North Korea, South Korea. It's not a solution where anybody actually wants to pull the trigger, but they want a position until maybe they can find an opportunity one way or the other to resolve it.
After starting gradually over the past few months, the Fed in September will allow roughly $60 billion of U.S. Treasury bills and $35 billion of mortgage-backed securities to mature each month without reinvesting, which will gradually reduce its balance sheet.
So if they pull back a bit, maybe house prices come down 10 to 15%. Net, it's still up from where it was. But, if you're looking at buying a house, you'll probably get it cheaper. But if you're looking at buying a house, you probably can't afford it right now because your mortgage has gone up and you're not earning as much money. So, and also worry about unemployment. That will not help the housing market. So the housing market is going to cool off.
Crypto is taking a hit along with stocks today, as the markets continue to try and find clarity regarding inflation, which will influence the Fed's roadmap for rate hikes. Unfortunately, it's a bit of a wait-and-see game right now until there is more evidence that inflation has peaked and is starting to decline. The next bit of data that could provide evidence of this is the Consumer Price Index reading in early September. So do you think that the Bitcoin market has already seen the low? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.